Hello, guys, you're welcome. In the business of trading, knowing how to read market structure is one of those few skill sets you cannot do without. Understanding market structure and knowing how to work in and with them will definitely help you boost your anticipation skills in predicting the market prices, help you to better time your entries, and it will also help you to have the right expectations of the market per time. Now, all this will work together to increase your profit potential while reducing your risk. It will also help to increase the percentage of wins of your strategy. Now, all of these is dependent on your understanding of market structure and the right application of it across the time frames. As you know, or as you should know, it is more powerful to frame your trading ideas right from the higher time frame and then narrowing your view down to the lower time frame to support better entries for um, little risk but capturing big moves. So when we talk about market structure, basically, what do we mean? All right, market structure is just price data and how price has, you know, happened or what happened in the market based on price in the past. All right, so we are looking at price basically to help us find the pulse or feel the pulse of the market, find what the market is most likely going to do, where the market is heading to in terms of price. All right, now that's what we used to trade, and when we buy, we're expecting price to go up, right? And when we sell, we're expecting price to drop lower for us to close in profit. And so market structure will help you to kind of have a sense of the direction of the market so that you can better time your entries, that's like we've said, and get a higher um, probability trade. All right, so without wasting time at all, we're going to get right into the heart of the discussion. So we have different ways. Now we are going to attack this um, right away. Well, let me quickly say this. We have different types of or different ways of reading market structure. Market structure is just you looking into the price, looking into your chart to digest or find the information that you're trying to present to you, all right, as to what the market is doing or most likely to do. So, this is how we're going to attack this very topic. First, we're going to talk about market structure formation, and we're also going to be talking about decisive price ranges, indecisive price ranges, and I'm going to be giving you examples of what they mean or showing you graphic examples of them. We're also going to be talking about reversals and continuations. Then we'll be talking about trading the market structure. Now I'll be giving you examples, you know, of how this all information can be applied to help you achieve the result that you want in your trading. Okay, so I'll be showing you from the higher time frame down to the lower time frame and all of that. So, but we're going to be building from ground up. So the first thing that we're going to be talking about is the market formation. So let's go. So the market structure formation. When we talk about market structure, I would believe that you've heard about higher highs and higher lows before now. But we're going to start from the ground up. All right. So I want everybody to catch up. I want everybody to be carried along. So if this is your first time of, hearing about market structure, so we are going to build from the ground up and get everybody along. All right. So the smallest unit of market structure is the tick. All right. So the ticks is nothing less than those frequent price changes you find or you see whenever you open up a chart. All right. So when you open up a chart, you find the chart displaying, just changing prices frequently. Sometimes a couple of times in a second, or in a minute. You see price just changing from one price um, value to another price value. So those ticks are what are now recorded. Those ticks are displaying the changes in price. You understand? Ticks are just the changes in price. Now those changes in price are now recorded and presented to us in form of a candlestick. We have other chatting, other kinds of charts. We have the bar chart, we have the lines chart, and we have other charts. You know, but for this discussion, we're going to be using the candlesticks, and is by far the most popular um, kind of chart being used to engage the market. So that's what we're going to be dealing on. So the ticks, like we said, is the frequent changes in price. We see so price changing, so ticking, changing from one price value to another. So those ticks are what comes together to form up a candlestick. All right. So depending on the time frame you're watching. So if you're watching the 1 minute time frame, then the candlestick will represent the ticks of 1 minute. All right. So every 1 minute, you're gonna have a candle representing the price history of 1 minute. All right. So if you're looking at the monthly, then it's the ticks that the changes in price that we had, the different points that price has gotten to over the 1 month, and all of that is going to be represented in the candlesticks. It's going to be presented in the candlesticks, but the candlesticks mainly shows us only four informations. Number one, the open, the high, the low, and the close. Now, we have a slide here where we talk about candlesticks. I think that's the next slide, and when we get there, we deal with that more deeply. Uh, deeply. So the candlesticks will now form the price ranges. So candlesticks will come upon, candlesticks will come together to form price ranges. Just like ticks will come together to form the candlesticks over a time period, then candlesticks over time period will come together to form the price ranges. So multiple ticks form the candlesticks over a certain time period, and candlesticks multiple candlesticks form the price ranges. Now, price ranges are what forms the market structure. Don't worry about the terms I'm using. I'm going to break all this down as we continue. So I'm just giving you the flow. We have the ticks. The ticks give back to the candlesticks. The candlesticks give back to the price ranges. And the price ranges give back to the market structure. All right. So we've talked about ticks, and we're not going to spend much time talking about that again. So I'm just going to jump right into um, talking about the candlesticks, and we take it from there. So yeah, candlesticks. So the left of your chart of your screen rather, you will see the green candle, all right, and there is an arrow. This arrow right here is pointing upward. So what does this is a bullish candle, while this is a bearish candle. So you have the open of price in a bullish candle. You have the open of price here, low, and the close is always higher than the open. So you have the low, you have the open, you have price establishing a high, then a low, and then a close. All right. So those are the four informations that you are given. So instead of the chart showing you all of the price numbers or the price values that have price has switched from over the past minute, and that would have been very very confusing, and there's absolutely it would be very difficult for you to know how to use that to trade, right? But using the candlesticks makes it all easy on the high and makes it very easy to interpret price. So the candlestick shows us the open. So let's say, for instance, we're looking at the 1 minute time frame. So it shows us the open of the last of the 1 minute um, we are looking at of this candlestick. So this candlestick represents the price action of 1 minute, and it shows us the open, shows us the close, shows us the high, shows us the low. The opposite is true in the case of the bearish version of the candlesticks. So we have the open, and the close is always lower in value than the open. And this is the body of the candle. Why this is the wicks, you know. So this makes it very easy on the high. So let's just jump right in, because I know most of you must have gone through this process of, what a candlestick is. Now we're gonna be talking about price ranges. Like I said, the candlesticks are what comes together to form the price ranges. And so we have two different types of price ranges that are broken down here. We have decisive price range, we have indecisive price range. All right, so the decisive price range is what we're going to be talking about first. Now, we have the bullish and the bearish forms of decisive price range. And just like you see on your chart, the decisive price range is to your left. The same thing with the bearish. Both of them are decisive price ranges, but you just given the two different forms of a decisive price range. You have the bullish form of it, and you have the bearish form. So what does a decisive price range mean? A decisive price range is like a swing in price, where we see market prices going from one point and moving decisively up to another point. All right, so it moves strongly away. Now, when you look at these are several candles forming this. The price was just going up and up and up, so all the candles were just mainly pointing upwards, until we got to this point B, where we could see a notable retracement. So price swings are those movement in price we see that happen over time, you know, over multiple candlesticks. We see candlesticks playing on top of each other without seeing any notable form of reversal happening. Okay, so we don't see any notable form of retracement happening. So you see, from this point A to this point B, you saw that price was just making that move, and until this point, we couldn't find any notable retracement. Granted, we had, you know, several bullish candles, rather bearish candles in the mix. You know, we had several bearish candles in the mix, but those were not notable retracements. The trend just kept going up and going up onto this point. This is where we began to see this coming in, and this is the definition of a notable retracement. Okay, so that is what a bullish decisive price range is. This is a bullish price range, decisive price range. So if you look at it, you will find it just almost like the candlestick we talked about. The bullish candlestick price opens at the low at the price and closes at the higher price. So the bullish price range starts from a point A and closes at the point that is higher than point A. So in this case, we have point A, price moved from the point A to the point B. And we saw that it's a decisive price move without any retracement in between. And we have multiple candles in it, forming it. Okay, so this is a very decisive price range, because price was actually making a decisive move right here. So we can see that market was clearly going up in this case. So this was a bullish price range. And in the bullish price range, we said that price will make a decisive move to the upside. And the opposite is true for the bearish price range. We have price making a decisive move from a point A to a point that is lower than the point A. So we had price moving from a point A to the point B very decisively. Now look into the price range, and you could find several bullish candles in there. Up close candles are within there, but they were not notable retracement in price. So they were not notable retracement. So price just moved all the way from that point down here. So this is a swing, a price swing, moving all the way from up there down to this point. It was until price got here, that is when we now saw a notable retracement. All right. So that is for the bearish price range and the bullish price range, the decisive price ranges. So now we talk about the indecisive price ranges. We just talked about a decisive price range. Like we said, a decisive price range, just as the name suggests, is when the market is making a decisive move. All right, so it moves from one point, clear movement, to another point. It moves from a point A to a point B in a clear, decisive manner. But in an indecisive price range, we have the opposite as the case. So price doesn't really make any decisive move. The move it makes is not really indicative of the direction it wants to go. Okay, and now here we have three forms of indecisive price ranges. Number one, we have the sideways indecisive price range. Number two, we have the contracting indecisive price range. And number three, we have the expanding indecisive price range. So now let's show the graphical representation of this, and we get to explain it. So indecisive price range number one, we have the sideways indecisive price range. Basically, price is just moving sideways, and you can actually box it out. You can actually use a rectangle and place it on and place it around price. You can see the highs or the tops are almost kind of relatively equal. The lows relatively equal as well. And price was not really making any decisive price move. Can you see this? Compared to what we talked about decisive price move, there was no real clear direction in price. Price came to this low, to the high, back to the low, back to the high, back to the low, back to the high. All these was indecisive. It was not indicative of a clear direction of the market. So what do we do with the decisive price range? A decisive price range kind of suggests to us the direction of the market, but an indecisive price range kind of leave us in the dark as to where market wants to go. Okay, so the price suggests to us, the price action of a decisive price range suggests to us a clear direction that the market is most likely to go. But an indecisive price range, the market does not suggest to us anything, and we are left in the dark, and it is a very risky time to trade the market. So the number two form of an indecisive price range is the contracting indecisive price range. So the former one was a sideways price range where we have the highs equal and the lows equal, but the range in between is very tight and price was not really moving anywhere, right? But in this case, we have a contracting indecisive price range. So instead of having a kind of equal top in that type range, we now have a situation where price is contracting, sort of. So you can see like the graphical depiction here. We have price, from this first range and then begins to move sideways. And when you connect lines across the top and across the bottom, you will get a formation of a contracting range. So here, the beginning, the range was kind of wide, and as we progress, it became smaller and tighter and smaller and smaller. So this is like the former one. You know, some people are gonna call this a chart pattern. Like for instance, they would say this one is a falling wedge, right? This is a falling wedge. And so people are going to be trading the breakers and all of that. But for my own style of trading, I don't trade these. When the market is in this kind of contraction, I don't do anything because in terms of market structure, this is a very indecisive price range. very indecisive, and the market is not really showing you a clear direction of where it is going. Okay, now when I feel kind of I really want to trade these, I really want to trade on that day, and we have this kind of price range, then I want to couple this whole price action with the former price data or price history, or where price is coming from and what price has done before we came into this price range. And then I want to look above and below price to find the key levels. Because just like I will point out to you in subsequent videos to come, these kinds of price patterns are what the market makers and the liquidity providers mostly uses. They play around with this kind of chart patterns around key levels, and they use it a lot to kind of create liquidity for the institution traders coming into the market. Okay, so for instance, a lot of people would say this is a falling wedge and all of that. The bottom is holding, the top is contracting or falling down, and then they wait for a breakout like this and they're looking to chase price. You understand? So, but if the market is actually breaking into a key level, that's it. There's really the anybody who is trading this is gonna be trapped because the market is just gonna reverse all the way down. So when I feel like okay, I want to trade this, then I want to look at former price data, and I want to look below and above price and see where the market is most likely to break into. Is it just an open space, or is it a key level? If it is a key level, you want to be very, very worried about that because you don't want to trade that kind of a breakout. A breakout into a key level is not, it doesn't make any sense whatever to trade it. Okay, so but based on market structure, what we're talking about here is this range, and we say it is an indecisive price range and it is a contracting indecisive price range. The market is not suggesting to us anything. It's not suggesting to us a clear direction of what it's going to be doing. So you can understand that looking at these, if I'm feeling like I want to trade, then I have to go outside of this and look at the whole market structure, find the key levels. You understand the point? Okay, but this on its own doesn't show us anything. And you're gonna find things like this a lot in price. Alright, so the next one is gonna be the opposite. And the opposite of it is gonna be the expanding indecisive price range. Now this has to supposed to be number three. I should have changed that. But any which ways, this is the number three type of indecisive price range, and we have the expanding form of an indecisive price range. So what it means is self-explanatory. It is just right there. We have price kind of creating ranges and breaking the high and the low of the former range. So that is kind of indecisive in nature as well, because the market is not showing a clear direction of what it's going to be doing. So in this case, for instance, the market comes down, creates a price range here, break the low of the former price range, the starting point, breaks the high, comes back again to break the former low. Now, the market here is not respecting the low or the new ranges are not respecting the lows or the highs of the former ranges, so that they can suggest to us, okay, where the weight of the market is kind of lying. Okay, so in this case, it is very unclear and very uncertain as to what is most likely to happen next. Now, sometimes this kind of price action comes into play when they are looking to disrupt the trend, when the trend is looking to end and being disrupted. So you have this kind of movement in price taking liquidity on top here and below there. Now that's a discussion for another video. Obviously, we're not talking about institutional concept in here. We're just talking about market structure and how to read it and interpret what the market is doing per time. So, but in this case, we have an expanding indecisive price range, and there was this kinds of movement that looked as though it was making a clear movement, but in truth and in effect, it was not making any clear movement.
It was actually, this was a very confusing move, and it is best to stay, at the sidelines when you see this kinds of price action. All right. So we've dealt with decisive price range. We've dealt with indecisive price range. So decisive price range, like I said before, now it is very clear as to what the market is going to be doing. Okay, the market moves strongly from a point A to point B, and you know that is a clear indication of what the market is most likely to do. It is a very strong movement in price, and most of the time, the starting point is respected. The starting point of those price ranges are respected. And when we go into the charts, you understand more of what we're talking about here. Okay, but you just want to know that when it comes to decisive price ranges, it is very clear as to what you should be doing in the marketplace. But indecisive price ranges leaves you in the dark, and you want to stay at the sidelines and watch how the market will play out before you jump right in. So now let's talk about the market structure. So right here, you're staring at the volatility 75 index, and this is the 4-hour chart. And here we have an example of a bullish market structure. Okay, now you're gonna see how the price ranges come together to form, you know, the structure of the market. So you see, we talked about the ticks forming the candlesticks. The candlesticks come together to form the price ranges, decisive price ranges and indecisive price ranges. The candlesticks forms all of them both. Okay, and now the price ranges come together to form the structure, right, of the market. And the market goes through periods or times or phases, all right, as it progresses or breaks down. And so understanding the moving part of a market structure, just like we've pointed out, a decisive price range and indecisive price range, understanding those are the the moving parts of a market structure. And so understanding when those moving parts begin to print, you get to understand, okay, what the market is suggesting to you or telling you to do. So like what we can see here, this is a bullish market structure. And in a bullish market structure, what we see is the market is going to be making stronger bullish, price ranges and weaker bearish price ranges. So remember we talked about bullish price ranges. So this is a decisive price range coming up. Now you didn't see the beginning of that, but then a weaker bearish price range coming down. Another one, decisive price range, weak. So we have a very strong bullish, weak bearish price range. So in the bullish market structure, we're going to be seeing strong bullish, price actions and weak bearish price actions. So in here, in this old frame that we're seeing right here now, we can see a bullish price range, all right, decisive price range. You can see a bearish price range, and right here, what is this? See where the yellow line is circling? So this is an example of, um, like from here to here, it's an example of a contracting price range, and then price moves up, breaking out of the price range and going all the way up. All right. So in this market structure, we are very clear of what we are going to be doing. So what we have here basically is this: price makes a run up and retraces. So when we see the run up, we don't want to see the retracement take out the low of the run up. Okay, so like for instance, we had price running up, retraces. We don't want to see this retracement breaking the low or that started the run up. We don't want to see that. So that is a bullish price action. So when we have that, we have, the market suggesting to us that it's going up. So when we have this going up, when we have this retracement, we don't want to see this breaking this low or this low. So for we to continue or see this market as one that is still bullish, it has to respect this price range up, this bullish price range up. this retracement has to respect the bullish price range up. All right, so that's for the bullish market structure. So with the bullish market structure, the characteristics is very simple. The characteristics is this: you have stronger bullish um, price ranges, stronger bullish price ranges compared to the bearish price ranges, which are going to be weaker in form. So the bearish price ranges are not going to be taking out the lows of the bullish price ranges, whereas the bullish price ranges are going to be taking out the high of the bearish price ranges. So in that case, you're going to be having something like this, 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 that kind of movement, just like you can see on your screen right now. So let's talk about the bearish market structure, the bearish version of what we just talked about. So in this case, you have stronger bearish price ranges and weaker bullish price range. So you can see price move down, then series of candles begin to form and push price up, and then price begins to move down again strongly, series of candle form. So you can see that right here, this was a strong bearish move. The retracement doesn't take out the high, the starting point of this strong price range, then price creates another price range. So each time the price breaks out, so each time the price breaks or consumes the former price range, then you understand that the new price range has been formed. All right, so that is why these kinds of bearish market structure is this is a decisive market structure. In this decisive market structure, price is not just trading only within ranges. It is actually, its range is established, price retraces back into the range, but then breaks out of the range, retraces within that range that was just formed, then breaks out again, retraces within, and breaks out again. Okay, so you have something like this: a lower low, a lower highs forming in the bearish market structure. But in the bullish market structure, we have the higher lows and the higher highs, the higher highs and the higher lows, just like that. Okay, so right here we see price dropping. It's a strong move down, weak move up, 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 strong move down. Okay, so that movement establishes a bearish market structure. And when you see a bearish market structure, all you want to do, guys, is to sell. Is to find an advantageous point or an area in price where you want to be selling. Okay, so when you understand market structure, it kind of gives a direction for your trading, because just as you can see, we have stronger price ranges coming down than we have going up. Okay, so in this market, more of the money was made selling. So the weight is to the downside, and that defines for you what you want to be doing. You don't want to be buying in the bearish market structure, neither do you want to be selling in the bullish market structure. So understand the market structure kind of defines for you what you should be doing. In an indecisive price action, where we have like the indecisive price range printing out, you don't want to be doing anything. And that also is a decision. So buying, selling, or waiting is a decision. And the price action will suggest that to you. When the market is about to reverse, right? What does it have to do? And that's what we're going to be talking about first. So when you look at the screen now, you are seeing the 4-hour chart of the volatility 50 index. And first of all, we see price coming up. This is a bullish market structure to the left, where we have price creating stronger ranges going up and weaker ranges coming down. So the ranges that are coming down are not taking out the lows of the ranges that are coming up. All right, so we have higher highs basically and higher lows. All right, so and the bullish ranges are being respected by the bearish ranges. The bearish ranges are being disrespected by the bullish ranges. Okay, so but when the price is about to make a shift, we are going to see a change in that trend, where we are not going to be having, instead of the bullish ranges being respected by the bearish ranges, we now have the bearish ranges disrespecting the bullish range. And what do I mean by disrespect? Breaking the lows of the bullish range and establishing itself as the force in the marketplace. So let's say we have market retrace here and make a very strong bullish move up, and this is a bullish price range. Multiple candles stacking on top of each other and going up. Then all of a sudden we see another price range forming. Now this price range comes and breaks the low of the former bullish price range. That right there suggests to you that a change in market structure is most likely about to happen. Now you're not just going to run off and say, okay, there's a change in market structure. Oh, it's all right. The market is already suggesting to you that maybe it's about to change. All right, it's movement. But you don't just go run off to the chart and begin to sell. You want to wait for the market to establish its high here. You want to establish a second high. That means a lower high. In the case of a bearish reversal. So let's say, for instance, we have now, just like I've just talked about, this prior run up, which is a bullish price range, now broken here. The market broke it down here. And so a new order is kind of, emerging in the marketplace. We now have a stronger bearish price range. Stronger bearish price range. So your reversal is not all that complete yet, simply because this is a breaking market structure. But there's a highly, there's a high, likely chance or likelihood that this is actually a shift in market structure. But we are not going to be all that completely sure until we see a retracement that respects the new price range, bearish price range. So this is a bearish price range, this is a bullish price range, and then this is the bearish price range taking out the low of the former bullish price range. So we've been seeing bullish price action coming up. Now we have the bearish price action forming right already. So when the low of a strong bullish price range like this coming up is being taken out, that suggests to us that there is most likely a change in market structure imagine. So when you have this swing high not being able to go all the way up to take out the former high, then we can say we have a price reversal. Okay, so that is how you spot a reversal on your price action. So former bullish action coming up, then all of a sudden you begin to see the emerging of a bearish action. So a bearish price action or bearish price structure is one that we said have stronger bearish price ranges and weaker bullish price ranges. Stronger bearish price ranges, weaker bullish price ranges, stronger bullish price and bearish price ranges. But in a bullish market structure, we are going to be having the opposite as a case, where we're going to be having stronger bullish bullish price ranges as against weaker bearish price ranges, just like we can see here to the left coming up. Then all of a sudden we see here the market consuming this price range and now making this a very weak bullish price range compared to this one. And then this kind of confirmed the reversal where we saw this weak bullish price range. And then it gave up the ghost and we see another bearish price range, strong bearish price range forming, right? So when we are looking at reversal, that's basically what we are looking at. That the order or the trend shifts. So what was the former trend in this case? The former trend, like we said, I'm repeating this because you got to understand it. So the former trend in this case was strong bullish weak bearish range, strong bullish range, weak bearish range. That was what was happening before. Then all of a sudden you see strong bearish, weak bullish range. The market has shifted, right? It has shifted. So that is for the reversal, guys. So when we talk about continuations, basically the same thing. So continuation is after a reversal has been formed and we see just that trend continuing. Basically, that's what it is. So we see that this is a downtrend now forming. At this point, we've now confirmed that this is a downtrend forming. So we have a strong bullish, strong bearish price range where we have down close range, but the bullish price range does not come up to consume this. So we have a weak bullish price range giving up the ghost here. This is confirmation of a continuation. This is a continuation in price. The case scenario we just use here is that of a bearish reversal in price. So in a bullish price reversal and continuation, we want to have a bearish trend in place. And a bearish trend, we said, is one that has strong bearish price ranges coming down and weak bullish price ranges, and that creates over time a it creates over time lower prices. So we see strong bearish, weak bullish, strong bearish price range, weak bullish price range coming down. Then all of a sudden we want to see a disruption of that trend. Retraces but could not take out the low. So makes a failure swing and then continues higher. Okay, so it's just taking all this that we've talked about initially and just flipping it upside down. And that gives you a bullish reversal and bullish continuation. So, trading the market structure. And this one is my suggestion, guys. There are multiple ways that you can do this stuff. Even with one concept, we can create multiple strategies and multiple procedures, and processes, for engaging price, all from one concept. So, but this is my own suggestion. So, when you want to use market structure to improve your trade, this is how I do it personally. So, number one, you want to go to the higher time frame and know what the structure is telling you. All right, so know your structure or know your HTF structure. That's the number one thing. Know your HTF structure. So know your higher time frame structure. That's what that means. The HTF stands for higher time frame. So know your highest time frame structure because you want to be trading in line with the higher time frame. Okay, so let's say for instance you are a day trader, for instance, you want to be paying attention to the daily chart. All right, you want to be paying attention to your daily chart. So if you can use the higher time frame, you can use the daily chart to represent your higher time frame and look to drop down to the 1 hour, or maybe all the way down to 15 minutes. So you look at the daily chart as your higher time frame, and you want to understand the structure in play right there. So if you are having a bullish structure in your higher time frame, you don't want to do anything but buying in your smaller time frame. If you have a bearish structure in your higher time frame, you don't want to be doing anything but selling in your smaller time frame. So number two, right there, we say find the relevant key levels above or below price. So find the relevant key levels above or below price. So you need a significant time frame key level. So let's say, for instance, if you're using the daily time frame as your higher time frame, chart, what you could do is you could look above. Let's say, for instance, you have a bullish price action on the daily time frame. So you want to look below price, right? Below where price is for a key level where you will be expecting a kind of retracement into where price will retrace into, and then you expect a trade off of there to continue the bullish price action on that time frame. Okay, so you can look for the relevant key levels using the same daily chart, all right, or you can do that using the 4-hour chart, for instance. Okay, so but you don't want to come down to a smaller time frame. So you want to use a relevant time frame, a time frame that is still considered as high. And for me, when you cross the 1 hour downwards, you're not talking about anything key anymore. So for me, key time frames will start from the 1 hour to the upside, at the 4 hour, the daily, the weekly, the monthly, you know, that kind of a thing. So you first of all know the structure on the higher time frame, then find the relevant key levels above or below price, as the case may be. So when price comes into your higher time frame key level, go to your lower time frame not too far apart. So your lower time frame must not be too far apart from your higher time frame. So let's say for instance you are using the for the daily rather as your higher time frame chart, then you don't want to be going anything lower than the 1 hour to look for the structure of that market. Now you can, granted, you can go down to the 5 minutes, you can go down to the 1 minute if you care, you can go down to the 15 minute to look for your entries. But when we're talking about structure and the breaking market structure to spot a reversal and a continuation of the trend on a higher time frame, you don't want to be doing that on a lower time frame, on a time frame that is too far apart. Okay, so a good rule of thumb is if you're using the daily, then you want to use the 4 hour or the 1 hour to look for the structure and spot a kind of reversal to continue the trend on the higher time frame. So on the 1 hour on the daily. So if you're using the weekly, you don't be using any time frame that's lower than 4 hours to spot the structure, right? On the time frame on the weekly, you don't be using anything lower than the 4 hour to look for the structure. So when the market is retracing into your higher time frame key levels, you don't want to be going to a time frame that's too far apart from that time frame. All right, so like I said, a good rule of thumb is this: you don't want to go 2 time frames away. So it must either be 1 time frame below your higher time frame, or 2 time frames below your higher time frame. So for instance, what I'm saying is this: if you're using the daily as your higher time frame, you don't want to be going 1 time frame below. You want to be going 1 time frame below or 2 timeframes below, which is going to be either the 4 hour or the 1 hour chart. Okay, so if it is the weekly, you don't want to be going below 4 hours. So you see that you're going to be using the daily or the 4 hour to mark, to find, to know, to see a clearer structure of the market, and look for the break in market structure that will reverse price back into the trend. So after that, now you now look for your entry as price makes a retest on your lower time frame. So you can now look for your entries as price make a retest. You first of all look for the reverses, then you can if you want to go down to the lower time frame, you can do that. If you want to go down to um, maybe the 15 5 minutes to trim your risk down, you can as well do that. But you need to understand what you're looking for. You first of all need the high time frames and the relevant time frames for checking your breaking market structure. Okay, so once you check those breaking market structure, then you can go down to the lower time frame to look for, you know, a smaller um, risk entry. So let's look at how that is with an example before we close. Okay, so this is the daily chart of the volatility 50 1S index, and just like you see here, this is the higher time frame structure and key level. So structure of price right here is very clear. We are having a bullish price action. So we've seen strong bullish price ranges, weak bearish price range coming down, strong bullish price range, weak bearish price range, strong bullish price range going up. So we can say safely that we are in a bullish market structure. So this is a bullish market structure, and in a bullish market structure, we are only concerned with one thing, that is buying. We know that it is more safer to buy, and which means it is less risky to buy. All right. So because the weight in this marketplace is towards the upside, is the buy side. So now we are waiting for when market. This is now a range. And so when the market retraces, we are not expecting this retracement to take out this low, the low of this range, the low of the price range. We're not expecting the market to take out the low. And so let's say, for instance, now we have the benefit of hindsight, and it is what it is. So we now say, okay, let's say, for instance, we saw price coming into this level before it did, and we say, okay, this level, we're expecting price to come in there. So we're expecting price to retrace back into the level, and we are looking to trade around that level. And what is our trading direction? To the upside. We're looking to buy when price comes into the level. We're looking to buy to the upside. All right, so when price retraces, what you're going to be doing is to go to your lower time frame. So now you found your higher time frame structure, and you found the key level to trade off of, and you're waiting for what? The retracement. So price retraces back into it, and now you're on the 4-hour chart. 1 hour time frame, one time frame lower than your higher time frame. So we're now on the 1 hour chart, and what we can see here is just normal price structure. All right, and you can see price dropping down. This was a decisive price range. Then price drops down again and goes up, but couldn't break the high of the former price range, because when this broke the low of this price range, it now establishes a new price range. So this, you can see where that yellow is marking, this becomes the new range. So if price, after touching our key level, breaks above this high, we can now say, okay, we are now expecting to see a reversal. We are now waiting for just a retracement back into the range that breaks the bearish trend, the range that breaks the bearish trend. We now wait for a retracement into that range down, and if it makes a failure swing, we can now be looking for higher prices going up. So, but in this case, we had this range, price comes up, respecting the high of that range, it drops down again lower, deeper into our key level, and this is now the new range you are going to be working with. This one, because what? It broke the low of this price range. So from this high to this low, this is your range. Now, until when market breaks it, like it does here, until when market breaks the high, we are not going to be expecting to see any form of, we're not expecting to trade or take a position in the marketplace. Price has come to the market, the key level. All right. So all we're waiting for is that breaking market structure, and that's what you have here. So the top of the price range is broken to the upside, and now we have an idea of saying, okay, maybe the market is looking to go up, but we're not sure yet and too ready to make our commitments yet. Okay, so we expect to see a retracement after the break in the market structure. We expect to see a retracement that does not go below the range that broke the structure. This was the range that broke the market structure. We are not expecting to see this retracement go below the starting point of this range. So if we are if we are talking about, if this is an example of a bullish reversal, okay, so if we're talking about the bearish reversal, the opposite will be the case. So you can refer back to the example of the reversal and continuation slide that we had, and so we talked about bearish reversal right there. So, but we can see that this range now, which is what we're looking at, has now been broken to the upside. So this rejection, we need to see a failure swing. So this was a failure swing because it doesn't break this level. It drops. It can now be called a retracement. It drops, but doesn't take out the low. So the moment it begins to show us bullish signs of going back up, then you can now be expecting to see higher prices, like we saw here, and then it continues higher. So now you have the sign all the signal that you need to now be looking for bullish price action, and so you are free to take your entries in price. So let's take a look or a closer look at the same market structure. Now this is the 1 hour chart, and so when we open up the 1 hour chart, we see that, you know, everything becomes even more clearer. You understand? It becomes more clearer. So we see a bearish price range. The market comes up, just follow the yellow lines as a draw, and breaks down, taking out the former low of this price range, taking out the low of this price range. So we have now a new range to work with inside our key level. So this range, if we are looking at for breaking market structure, this range, the high of this particular range has to be broken. Not this one, this one. Because this one has taken out this low, the low of this price range, and it has established itself as a significant price range. So this price range, bearish price range, has taken out this low. And so we're expecting to see when price will come back and break it. It doesn't do it here. It respects the high and drops lower, just like we saw it on the 4 hour. It's just that here it is even more clearer. Okay, we see it drop all the way down, now taking out the low of this one. So now this price range is now the significant price range. Even though we're looking at the same high, it's not the significant price range. So we expect the market to do what? Break it to the upside. We saw bullish price action, but that's happening within the price range, and so we're not concerned about that. You see the market making higher high, low, higher high, and higher low. But until it breaks to the upside, until it breaks this level, the high of this, now the key price range that we're looking at, until it breaks the high of that price range, we are not concerned about doing anything. We are not looking to trade to the upside, right? Granted, we are in a key level, but we are expecting um, the reversal to happen, and we've not seen price action suggesting that the reversal is taking place in here. Okay, but finally, price breaks the market structure, retraces back into this price range that now breaks the market structure, retraces back into it, doesn't take out the low, and then it continues higher. Another opportunity to go long, and this was an opportunity to go long as well. It just breaks out this high, retraces back into the price range, and expands to the upside. Then we have the strong pullback coming down. Up move, down, breaking this low. Now this level is now a key price level to look at. If that level is broken, we could have bearish signals, or we could have bearish movement going up, and that's exactly what we see here to the upside. So you can see, guys, that when you have the knowledge of structure or price structure, right, and you use that to create a process of higher time frame analysis to the smaller time frames, it can help give your trading direction. It gives your trading more weight, because you're going to be trading off of the trend of the high time frame. You're trading off of a key level on the high time frame, and then you're trading also in the line with the market structure on the lower time frame after your key level has been hit, right? After price has come into your key level, you are not trading based on the market structure on the lower time frame. So everything lining up together, this gives your trading a very high probability for winning. It gives your strategy high probability. Okay, now you're gonna wait for these things. You have to be patient for it. But the truth is that when it comes, it is very clear what you're doing. You're not just in the lower time frame, you know, just taking all kinds of things. You can, if for instance you were on the lower time frame and you never knew that there was a key level here, imagine you could blow your account in this kind of price action. For one moment it looks like it's going up, for one moment it comes down, for another moment it goes up, it comes down, and it looked as if it was chaos, but from when you have the higher time frame perspective and you add that to this, it is no longer chaotic. It becomes very, very clear as what is happening, and you are very clear about your expectations. You understand? You're very, very clear about your expectations. So when you have the higher time frame and you bring that down to lower time frame, remember everything I said, that when you are using the higher time frame as your key, as your structure, you're looking for the structure and the key level in a higher time frame. You don't want to go down to a time frame that is too low, too wide apart. And I give you a rule of thumb. It should be one time frame or just two time frame below your high time frame. That's the time frame you want to be looking, or you want to be using to monitor the key level or price action as it comes to the key level. Then you want to see a kind of shift in the trend, right, as price comes into the key level. And we've talked about what the shift in trend would look like, whether in a bullish market structure or in a bearish market structure. So you wait for the retracement into your key level, and then you're looking for the rotation of price back into the trend on your higher time frame. Now, hopefully, this was very insightful. And if you have the questions, you can hit me up on my Telegram. And I think I should allow the comment section for this one to be on, because maybe some people are just gonna throw up some questions. But if you have any questions about my City Billions library, where you have the opportunity of learning, everything that makes me to see price the way I see them, and both institutional concept and pure retail concept, and trading strategies that are based on indicators, and these are premium strategies, strategies that I bought and strategies that I design. And there are some things that I don't drop here on YouTube that are going to be there on my on the City Billions library. Okay, so but if you have any questions about the City Billions library and you want to make inquiries or join, then you can chat me up on Telegram. All right, don't drop it in the comment below. Don't drop in the comment section. But if you have any questions concerning your trading, and whether this or any other thing concerning your trading, then you can drop it here, and I'll try my best to answer everybody. Okay, the only thing that made me not to put on the comment section before now is because of some people who just come in and post rubbish, things that are not even related to forex, not to talk of what we're discussing at all. Okay, so you see people come around and post things like dating sites and all those rubbish scammers, and there are people who come trying to sell programs. I don't understand why they're doing that. All right, the comment section is for you guys who want to learn more, or who want to just be an encouragement and say, okay, we're getting something from here. Okay, so your comment, I really encourage your comment, because it can give me an idea of, okay, what I should do next, and to know what you guys maybe find difficulty in grasping. All right, even though I have my own topics lined up already, but you could throw in your comments. All right, they're gonna be very helpful. Now, if you've not subscribed to this channel, you can subscribe, and you should subscribe. Okay, like and share the content. Um, and join the City Billions library, guys, if you want to grow faster and you really want to get access to very deep informations and those stuff. All right, guys. Cheers, and God bless you. Until next time. Bye bye.